What was different and refreshing about this budget is that right from the get-go, it spoke about manufacturing and semiconductors, getting investment into data centers. Over the years, all the taxes related to capital markets have been hiked. Charge capital gains tax for a foreigner. You are counting capital gains in rupees, right? But in dollar terms, they're actually losing money, and yet they're ending up paying tax. To make our market competitive and attractive, it was expected that they will relook at some of these capital market related taxes.
Amnesty scheme was announced for those who fail to disclose their foreign assets.
It is more for the small taxpayer, students who have not disclosed their foreign bank accounts while they were obligated to disclose the same, or people who are working abroad, they've had ESOPs, they've had RSUs, or other individuals who might have some insurance policies, and again they were obligated to disclose their foreign assets or foreign income, and which has not been disclosed.
What about ITR3? There's been some confusion over there.
What has been clarified is this, that in case you've got business income or profession income and which is not liable for an audit, that date now has been pushed from 31st July to 31st of August.
Buybacks now have been taxed at capital gains.
This is a welcome reconsideration where they said, okay, if you're an individual promoter and you do buyback, then to the extent that the promoter is tendering his or her equity in the buyback, it is still taxed at 30%.
You don't ever see STT going away.
If you talk on principle basis, then STT should have been removed. So unfortunately, 2026 looks like a challenging year. I mean, it's not a year when people can really stick their neck out and be aggressive or bat on the front foot. It's a year where you have to be watchful.
Budget 2026 was announced, but contrary to major expectations, there were no changes in the income tax slab rates nor the capital gains tax, which many people had anticipated. We have with us in the studios today Homi Mistry, who is the partner at Deloitte, and Aashish Somaiyaa, who is the CEO of WhiteOak Mutual Fund, to discuss and dissect the budget for the common man and woman on the street. Hi, Homi, and hi, Aashish. Welcome to the podcast. So I want to start by addressing two big misses in the budget, and then we'll get down to the specifics. What does it mean for you all that, for example, let's start with you, Homi. No income tax, no slab rate changes, no income tax changes. And we've seen in the past that, the finance minister keeps things steady and constant for a couple of years, and then there are a huge big bunch of changes that are announced. So have we now finally settled on this regime, or you think something big can come in the future? What's your reading?
So Kayezad, as you know, last year there were a lot of changes for individuals in the tax slabs and all. The slabs went up, the tax rates came down, and there was a big focus. There was also a focus in the last few years on the new tax regime. And I think that new tax regime is here to stay. More and more people are adopting it. And the expectation is that it is going to continue.
What about the old tax regime? Do you think the old tax regime can finally go away, maybe in a couple of years, or that also would continue parallelly?
See, right now, obviously, it's continuing with the new tax regime. And it's possible that it may continue. But maybe the new tax regime, if more and more benefits are given in the new tax regime, assuming in the future the slabs are again increased, and even slightly reduce the tax rates, maybe a time may come when we may no longer need the old tax regime.
Ashish, no changes in the capital gains tax. I mean, that was it was a big fear in the market that maybe capital gains tax may be increased or, altered majorly. Now that no changes have been announced in the capital gains tax regime in this year's budget, do you think that now this regime is here to stay?
Yeah, so I think that while domestically for investors here, there was no expectation of any change to capital gains tax. But, given what has happened in the last year and a half, like if you see, for example, now if you take 2025, we underperformed emerging markets by nearly 30%.
Yeah.
Just the first 1 month of January, maybe we underperformed by another 10 to 15%. So two or three things. One is that progressively over the years, all the taxes related to capital markets have been hiked. So take an example, corporate dividends, right? So dividend is now fully taxed. Buyback was also taxed as dividend, which now they're partially reversed. If you see, apart from dividend taxes, you had long-term and short-term gains, and long-term and short-term gains have also been hiked. So we are at a stage where now long-term gains are 12.5% plus surcharge plus cess. Short-term gain is 20 plus surcharge plus cess, which takes it to nearly 23.6 or something like that. And then you have STT, and that also has been successively hiked. Now, the key contention from capital market perspective was that you got back, you introduced STT when you removed long-term gains.
Yeah.
Now you got back long-term gains, you hiked it a bit, and you still have STT and you still keep hiking STT. So I think it's not like we expected some cut in capital gains tax, but there was some expectation that we will address this anomaly. Like take an example, we invest all over the world, right? We have emerging markets funds which invest all over the world, and those emerging markets funds invest in India also. So when you invest in India, capital gains tax is high compared to other emerging markets, right? In most of these emerging markets, foreign investors are not taxed, right? In India, but you have STT and you have capital gains tax. So take an example, last 20 years, India's return is 10% compounded in dollar terms. But for bulk of that period, taxes were much lower, or at some point in time, long-term gain was not even there. Now today, to get that same 10%, you need a gross return of what? Something like 11, 12 or maybe higher. So that would reduce your market's competitiveness. Because if you get 10% dollar return in one market and 10% dollar return in India, 10% dollar return in India would end up being less than maybe 8.5 or 9. Whereas 10% dollar return in another market, maybe. So, when people are investing all over the world, they're expecting that, there's this notion of what return will you get by investing in a market. Secondly, our currency has been slipping. So when you charge capital gains tax for a foreigner, you are counting capital gains in rupees, right? But in dollar terms, they're actually losing money, and yet they're ending up paying tax. So it was expected that not necessarily here, but to make our market competitive and attractive, it was expected that they will relook at some of these capital market related taxes. So that they've not relooked, and on top of it, STT has again gone up. Now, just one moment. I mean, even STT, what was said, the clarification was given that it is, leading to speculative trading in FNO. So to, curb that and to make it unattractive, we want to charge STT on FNO. But all FNO is not speculative. Like the mutual fund industry manages 10 lakh crores in hybrid funds. Their FNO is used to reduce volatility of the equity proportion. Industry manages more than 3 lakh crore in arbitrage funds. That also FNO is used to reduce risk and to create a hedged position. They're looking to reduce speculation, but in that, you're throwing the baby with the bathwater, because even genuine activity is actually going to get punished.
We'll discuss markets a little later, but let's turn our attention to the tax matters announced in today's budget. Homi, there was, the big news because as I said, the slab rates didn't change, but there was a lot of penalties and provisions and, ease of doing business from the small investors' point of view being announced. Amnesty scheme was announced for those who failed to disclose their foreign assets. Now, there were two categories, like, either you have not disclosed your income or an asset purchased through a disclosed income, or you have not disclosed your asset. Can you just explain us briefly as to how big or small is this measure, and who will it affect, and what's the impact on the ground?
Kayezad, this is a new scheme which has come out. What the finance minister said, it is more for the small taxpayer. It could be individuals who are either students who have not disclosed their foreign bank accounts while they were obligated to disclose the same, or people who are working abroad. They've had ESOPs, they've had RSUs, or other individuals who might have some insurance policies, and again they were obligated to disclose their foreign assets or foreign income, and which has not been disclosed when they were residents and ordinary residents in India. So this kind of amnesty scheme now has been announced. It's been announced it's going to be for about 6 months. It's obviously going to come into effect sometime in the next financial year. And what's been basically mentioned is that if you have not shown your foreign income, which you are obligated to show, or your foreign assets, when you were a resident, in that particular case, you will be liable to pay tax at the rate of 30% on the fair market value of the asset as will be prescribed by the government. And if there's foreign income which has not also been disclosed and where you not pay tax on the same, there also you have to pay tax at the rate of 30% on the tax on the same. In addition, there will also be an additional tax of 100% of the same. And this benefit is available only where the aggregate of the undisclosed foreign asset and foreign income does not exceed rupees 1 crore. So that is the first category. In addition, there may be cases where individuals have offered their foreign income to tax, but inadvertently they may not have also disclosed their foreign asset. It's possible,
Like a house or something.
It could be a house, it could have been shares, etc., bond shares, etc. So in that case, they have to pay what is called a fee of up to 1 lakh rupees. And that benefit is available in the case of those foreign assets which do not exceed rupees 5 crores. So that's what basically this scheme is about.
How is this better than the scheme that was prevalent earlier, and how it would help incrementally to people?
See, the earlier scheme which had come up, that had come out in the year 2015. It was for about 4 years. That time also, obviously, you had to pay the taxes, and obviously there was, you had an amnesty, etc. So this may be better in the sense that, if you pay the necessary taxes, etc., there won't be any penalty. There'll be no prosecution also. What I would also like to just point out to you is that even under the Black Money Act, a couple of years back, there was a provision brought in to state that if you had foreign assets other than immovable property, that means other than land or buildings, etc., and the value of those foreign movable assets, which you should have disclosed in your tax return, but they were not disclosed, did not exceed 20 lakh rupees, no penalty could be levied on you. This time, they've just clarified further to say that no prosecution can also be launched against you, provided the value of your foreign movable assets don't exceed 20 lakh rupees.
It's just basically want to make it easier for the cases to be resolved.
Correct.
And reach their logical
conclusion. And the focus of the government is that they want more and more people who should have been disclosing their foreign income, who should have been disclosing their foreign assets, And the government is getting a lot of information also from other governments, etc., under FATCA or under exchange of information agreements.
Another one of these measures that the finance minister announced was simply the belated returns can now be filed up to March. And I suppose even the revised returns, even if prosecution has been initiated against you, you can still file your revised return. I suppose provided on some conditions. Can you clarify that, and how that would impact people on taxpayers on the ground? How big or small is that measure?
See, earlier, Kayezad, the due dates currently are 31st July. Generally 31st July. There are different dates, of course. If you have even if you have got business income not liable for audit, your date is 31st July. Now she's clarified, and she says those who don't have have no audit, but who still have business income or like trusts, etc., she's given 1 more month to file the tax return. So you can file the tax return instead of 31st July, you can file up to 31st August without paying any kind of extra fee or anything like that. Of course, if you're liable for an audit, your date remains as 31st of October. If you're liable for a transfer pricing audit, it's 30th November. Now, what has been clarified that in case you want to amend your return, in case there's a mistake or there's an omission, etc., now the date has moved from 31st December to 31st of March of the next year. So you've got 3 more months for that. And for that, in case you want to revise your return and it goes beyond 31st December, you have to pay like a small fee. So if your income is up to 5 lakh rupees, it's 1,000 rupees. And if your income crosses that figure of 5 lakh rupees, then it's 5,000 rupees.
And I suppose as against the earlier case, now you can even file your updated returns even if proceedings have been initiated against you.
Earlier, you could not file updated returns in case you had a loss.
In case you have.
And you wanted to reduce your loss. But now if you want to reduce your loss, you can file an updated return if what they call reassessment proceedings, that is proceedings where the tax authorities believe that you have some income has escaped assessment. In that case, now reassessment proceedings or recomputation proceedings have also been initiated. you can also file an updated return, but then you have to pay an additional 10% of the tax figure. So supposing when you're filing an updated return, the tax and interest is, let's say, 25% more that you have to pay. Now it's going to be 35%, and so on and so forth.
So, Homi, one more tax question I wanted to run it past you. The ITR 1 and 2 have been clarified to have been to continue to be filed by July 31st. What about ITR 3? There's been some confusion over there. Is the date for filing ITR 3 returns under ITR 3 also July 31st, or has that been pushed back or something? Because that wasn't there in the budget speech.
Right. So ITR 3, Kayezad, is for individuals having a business or professional income. They could be liable for a tax audit. They may not be liable also for a tax audit. So now what has been clarified is this, that in case you've got business income or profession income and which is not liable for an audit, that date now has been pushed from 31st July to 31st of August. However, if you're liable for a tax audit, then and you're filing obviously the ITR 3, then in any event your date will be 31st of October. So there's no change on the date of 31st October. The only change is now from 31st July to 31st August for people having business income not liable for audit. And the reason also has been given that, they also need a little bit more time for preparing their books of accounts, etc. So that's why the government has given them one more.
Ashish, as an equity investor, what do you take away from this budget? I mean, any interesting sectors or any interesting themes that come to your mind after the budget speech?
What was different and refreshing about this budget is that right from the get-go, it spoke about manufacturing and semiconductors, getting investment into data centers, and giving encouragement to, say, electronics manufacturing, and then job creation, travel and tourism.
A lot of mention about AI also.
Yes. So, like till 2047, you're giving tax break to data centers, and So what I feel is that from all of those perspectives, the budget was quite refreshing, right? I mean, the focus in the right areas, and I think some of those will get a fillip. The other important thing to also keep in mind is that, for instance, whether it is infrastructure spend, whether it is the defense outlay, I mean, all of those were maintained.
And also the capital gains, Ashish, what you were discussing earlier at length. One of the things that we missed out talking on, and I wanted to address that here, is that a lot of bankers who were actually clamoring for equity between the capital gains of fixed deposits and equity. Yeah. Where do you stand on that? I mean, you've been an equity investor also, so you appreciate the risk that equities.
Yeah, so I can understand. Now, what has happened as far as fixed income investing is concerned is that over the number of years, rates have come down significantly. And for any economy to do well, you need interest rates to be lower, right? I mean, you don't expect. I mean, there was a point in time we used to always hear 10-year bond in the vicinity of 8 to 9%. In the last few years, we've heard in the vicinity of 6.5%. And obviously, that reflects in the government's debt burden and interest outgo and all of those. And obviously, everything else is priced off the rate at which the government borrows. So low interest rates are welcome. What has happened on top of it is that previously people used to invest in these fixed income instruments, say through mutual funds, right? Mutual funds were the mainstay, and mutual funds, if you invest, the NAV movement was taxed as capital gains. Now, what has happened is they've done away with it completely. So everything is taxed at marginal rate of taxation. But there is a problem that, you want low interest rates and you have fully taxed all of those. Now, the point is that if somebody is clamoring that, on fixed income, you need tax breaks. Now, how do you give tax breaks on fixed income? Because risk capital, equity capital, which is risk capital, on risk capital itself, your, long-term gain is 14.5%. Short-term gain is 23%. Dividends are fully taxed. So if risk capital is fully taxed, then where is the question of giving tax breaks for so-called no risk or low risk capital, right? So yeah, that's the conundrum. I mean, it won't be appropriate to give tax breaks on fixed income.
No, but I think
taxing equity
tax breaks on equities also, the capital gains tax.
Yeah, so but see, the thing is that, we've gone in a different direction altogether. Now to unwind all of that would be probably too much to expect, right?
Another the taxation thing that the finance minister announced was on sovereign gold bonds.
Yeah.
I want both of you all to weigh in. Homi, why don't you begin by telling us your perspective? Sovereign gold bonds, what's your perception about why the government may have done this?
So I think the whole logic would be what was happening, that you could buy from the stock market, okay, and then you could wait for maybe 2 or 3 years, and the government would then the government would redeem the same. You would get your money, and you would not pay any tax. What the government wants you to actually hold it from inception, like an original allottee, till the time of final redemption. The whole idea is not to just hold it for 1 or 2 years, to hold it for the entire continuity. So they say that if you hold it from the beginning to the end, we will give you a full tax exemption. That's the whole idea.
Oh.
That, in my view.
Yeah. But
I think they don't want to give a tax break for investing in gold, for example. It's not exactly productive capital in that sense, right? So, anyway, gold prices have gone up a lot. Anyway, the government has probably going to end up shelling out much more than what they anticipated.
which is
On
why
top of that, they don't even collect tax on it. Then I think it's encouraging a completely wrong.
Okay. But just to play the devil's advocate, just like how it happened with debt funds a couple of years ago when capital gains tax benefits were removed. Now, capital gains tax benefits have been removed on sovereign gold bonds if bought from the exchange. So I'm just wondering, what kind of a message is this for the investor who have been investing in financial instruments purely from the taxation point of view and not from a financial planning perspective? You think that its time has come now for investors to be more aware of why they're investing in a product rather than just putting money absolutely just for the sake of
See, that is always that's always financial planning 101, that there are tax benefits for, or tax differences in variety of instruments, but the starting point should never be taxation. Your starting point has to be your return expectation, your risk tolerance, and what exactly are you investing for. So clearly, that is always the case.
The other thing, Ashish, I wanted to ask you is that buybacks now have been taxed at capital gains.
Yeah.
What is the big rationale, and what should investors take away from this?
See, I just want to point out something which is not often discussed. It's quite a tragedy, actually. See, what is happening is that companies declare dividend from their tax-paid profits, right? And when from the profit after tax, when companies pass on the rightful share to the shareholders, that is what the dividend is. And then that dividend is fully taxed. So that is clearly double taxation, first of all, right? So when they started levying full marginal rate of tax on dividends, then obviously some people thought that, okay, if I'm going to pay tax on my tax paid income, if there is going to be twice there is going to be tax on the same income, then let me not pay dividends. Let me do a buyback, right? So then they said that, okay, even buyback will be added to the income and fully taxed. All proceeds from buyback will also be fully taxed. Now, there are 2 or 3 aspects to this. First of all, when you don't look at these things only from perspective of the promoter of a company. You have to also keep in mind that there are minority shareholders, and in some companies, promoter may be having 30-40%, some companies promoter may be having 60-70%. And in India, when a company gets listed, within 3 years, you have to bring promoter shareholding down to 75, which means public shareholding has to be 25. So in any case, those 25% of the people, they are not the promoter. They are depending on the vagaries of the market and vagaries of the promoter conduct, whereby they will receive something. Now you are giving an excuse not to declare dividends, correct? It gives rise to governance related challenges, first of all. Chalo, theek hai, that is done for dividend. Now when you block buyback also, when you make buyback also fully taxable, you are saying that, okay, there's no way to return income, there's no way to return capital. Right? So I think this is a welcome reconsideration where they said, okay, if you're an individual promoter and you do buyback, then to the extent that the promoter is tendering his or her equity in the buyback, it is still taxed at 30%. If it's a corporate which is tendering its own equity in buyback, that is at 22%, because sometimes what happens is that corporate could be some genuine private equity fund and they are tendering in, right? So it's 22%. And if it is a minority shareholder tendering in a buyback, then it is taxed as long-term gain. So this is better, right? It's better than taxing it fully, because if you tax dividends fully and if you tax buyback also fully, that means the minority shareholder will never receive, you are creating disincentive for the promoter or the company to return money to minority shareholders. You're giving them a valid excuse that, okay, let us only manage the money, let us redeploy for higher growth prospects, because if we give it to you, it's going to be fully taxed, right? So the side effect is poor governance and hoarding of surpluses unnecessarily.
Markets don't seem to have taken so well.
So it's not necessarily some big relief, right? You have reversed what was actually not so favorable. And on the other hand, of course, market for some reason is, extra disappointed with consistent. See, it's not about hiking STT. The point is you are consistently doing it, right? I mean, I think this is the 4th or 5th time STT has been hiked. So stick
And you
to your
don't ever see STT going away.
I mean, if you talk on principle basis, it was clearly said that STT is introduced because long-term gain was removed. So if we talk of principles, the long-term came back, it was hiked, then there is surcharge and cess. So if you talk on principle basis, then STT should have been removed. But okay, that's fine, they have not removed that. But what is happening is that we're not even sticking to a particular rate or a regime, right? I mean, we have this tendency to change it every year, 2-3 years. So there's no certainty. I mean, you cannot keep changing taxes like that.
Yeah, some amount of consistency is always good in a tax regime. Just one last question. Ashish, from a financial planning perspective and from an investment perspective, we are just at the beginning of 2026.
Yeah.
Budget is past us now. How should investors read the budget to be able to frame an asset allocation or frame a portfolio for the rest of the year?
Yeah, no, see, I'll tell you, Kayezad, what happens is that obviously we are operating in a larger context. I mean, budget is important, but now that the budget is behind us, I think the focus will move to the rest of the earnings season. And more importantly, Kayezad, what has been happening since a year and a half after the last general election, right? And a lot of water under the bridge. You have seen in 1.5 years, RBI's policies have changed. Credit policy has changed. RBI has pumped up liquidity, reduced interest rates. The government has been, back in full force, cutting taxes, cutting GST, announcing all types of incentives in various state elections, now 8th pay commission. So if you see domestic, I mean, barring today's STT and, all these discussions, leave them aside for a moment, barring all of that, generally domestic conditions have been improving actually, as far as macroeconomy is concerned. Is the external environment which is not allowing the market to, manifest that in the actual prices? Because the external environment is challenged on multiple fronts, whether it is geopolitics, whether it is this questioning of the so-called AI bubble in the US and the US economic conduct itself. So I think in a couple of days, we'll be again back to negotiating the external macro, even as domestic macro keeps improving. So unfortunately, 2026 looks like a challenging year. I mean, it's not a year when people can really stick their neck out and be aggressive or bat on the front foot. It's a year where you have to be watchful. So something about the US economy or the US market, that Damocles sword finally has to fall, and then we can move forward.
Thank you very much, Ashish. Thank you very much,
Thank you.
Homi, for your insights on today's budget. And thank you very much for watching the morning brief. For more news, views, and updates, keep reading Economic Times.